It is Tuesday afternoon. You are sitting at your desk, your coffee has gone cold, and your browser tabs are multiplying like rabbits. You click on your banking app, not because of an emergency, but because you want to feel that little thrill. $20,347. You read the number twice. Then you minimize the app and return to work feeling a little more secure than you did 5 minutes ago. At first, the 5-digit number probably made you happy. But here is the thing, no one told you about reaching $20,000. You thought this number would change everything. You thought you'd finally be free from the feeling that if you had a bad month, you'd be doomed. Instead, you sit wondering why you still feel like you are living on the edge of a cliff. If you look at your 5-figure savings account and think, I should feel richer than this, let's explore why you feel that way and what it really means. First, we need to assess today's conditions. For most people, $20,000 feels like some kind of grand finale. Once you reach $20,000, you suddenly feel financially secure you've achieved it. But what do you actually have? $20,000 is not the end in 2026 conditions. It is the beginning of the most dangerous financial period most people will experience. I call this the hidden money period. It is a period where you appear stable on paper, but you are actually more vulnerable than when you had nothing. Let me explain why. In the early 2000s, the average American household had approximately $23,000 in liquid savings, adjusted for inflation. Back then, this figure felt like freedom to people because the cost of emergencies was lower. A major car repair might cost around $800. Health insurance deductibles averaged around $500. Rent in a good neighborhood was around 20% too. It was 25%. Today, the Federal Reserve says the average household has about $8,000 in savings. That is less than half of what it was 20 years ago. On the other hand, what really matters is that the average car repair, transmission, or engine repair costs between $3,500 and $5,000. Health insurance deductibles average $1,500 for individuals and over $3,000 for families. In most cities, rent consumes 35% to 40% of the average income in most cities. That is the problem. If you manage to save $20,000 by 2026, you are actually ahead of most Americans. But the cost of staying ahead has doubled. Yes, that is how things are in 2026. You need more money to maintain the same level of security your parents had with half the money. This is not your failure. It is the system readjusting the cost of security. Now, let me tell you what you might encounter once you exceed $20,000. Your bank will notice your phone won't stop ringing. Suddenly, you start receiving emails about premium accounts, investment opportunities, and credit limit increases. Ads for services related to your interests appear on platforms like Instagram and Facebook, and even your banking app may start showing you unwanted offers. Wealth management services, high-yield portfolios, margin accounts, you are being upgraded. But there is something they're not telling you. These upgrades are not rewards. They are traps disguised as opportunities. Banks make money in two ways: fees from people who have nothing, and interest from people who appear to have something. You are probably in the second category. When you reach $20,000, you move from the fee farm to the investment funnel. You move up a tier. But remember this, they don't try to help you grow your money. They try to get you to move your money into products that earn them commissions. A wealth advisor may seem perfectly reasonable until you realize they take a 1% annual commission on managed assets. But 1% of $20,000 is $200 a year. You pay them $200 to tell you to buy index funds that you can find for free on Google. Especially credit cards, those credit cards with rewards programs that reward your lifestyle. Each offer is designed to turn your discipline into their income. Credit cards pose a risk to your rising wealth. The system is ingeniously designed. However, it is within your power to beat the system, to understand this important turning point. Well, let's talk about the next step, psychological change, because things get really complicated here. For months, maybe years, you were in survival mode. Every dollar mattered. You brought your lunch with you. You said no to trips. You bought the cheaper version of everything. You sacrificed some things and put them off because you were focused. Then you hit $20,000 and something shifted in your mind. You might start thinking, I've been so careful for so long. You might say, I deserve a little relaxation. And you do. That is not the problem. The problem is that you might be a little hasty about relaxing. You move into a slightly nicer apartment, It is only $200 more a month. You tell yourself it is worth it. You rent a car because you are tired of your car sounding like it is coughing every morning. You subscribe to a few more services. The 21st century system pulls you into a cycle of spending and consumption. Streaming, meal kits, premium gym membership. Taken individually, none of these are crazy, but together they form a new baseline. Your fixed expenses increase by $400, $500, $600. You are not being careless. You are just finally living like someone who can breathe a little. But now $20,000 is no longer increasing. It has remained fixed because your new lifestyle is so expensive that it prevents you from adding to this amount. Here are the data that make this a reality. According to a 2023 study by Vanguard, households with savings between $15,000 and $30,000 saw a 12% increase in their savings. This means you tripled your savings and only felt 12% better. Why? Because once you cross a certain threshold, stress stems not from not having money, but from the fear of losing it. You no longer worry about overdrafts. Now your concern is medical bills, job loss, or a market downturn wiping out everything you've built. So we understand that anxiety doesn't disappear. It just changes form. And this is where the hidden stage becomes truly dangerous. You've saved $20,000, so you think you should start investing. Everyone says you can't build wealth just by sitting on a savings account. And they're right. Inflation eats away about 3% of your purchasing power each year, meaning that the $20,000 you have today will feel like $19,400 next year if it just sits there. So you start looking at investment accounts, stocks, ETFs, index funds, maybe even cryptocurrencies if you like to take risks. The math is compelling. If you invest $20,000 and earn an average of 8% per year, you'll have about $43,000 in 10 years. If you leave that money in a savings account earning 0.5% interest, you might have $21,000. Investing seems like the most logical option, but no one tells you this part. The moment you transfer that money from a savings account to an investment account, the nature of the money changes. Savings are stable. It is boring, yes, but it is stable. Investments fluctuate. In a good year, your $20,000 could grow to $22,000. In a bad year, it could drop to $17,000. That is where the psychological trap lies. Let's say you invested and you have $17,000 left and you need money for an emergency. You have two options: sell at a loss and guarantee a $3,000 loss, or don't touch it and borrow money to cover the emergency. In either case, you lose. I call this the liquidity trap. You thought you were being smart by investing, but you inadvertently made your safety net less secure. Let me explain this with an example. There is a guy named Jordan. Jordan saved $22,000 over 3 years, then transferred $15,000 to a brokerage account and kept $7,000 as an emergency fund. 6 months later, Jordan's car broke down. The repair cost $4,500. Jordan only has $7,000 in his emergency fund. The brokerage account was down that month at $13,800. Selling would guarantee a $1,200 loss. Instead, Jordan charged the repair costs to a credit card with a 19% annual interest rate. A year later, Jordan would have paid $1,020 in interest and still owe $3,200. The investments recover, but Jordan cannot add to them because all the extra money went to debt. Jordan did exactly what standard advice says to do, but standard advice assumes emergencies will wait for bull markets. Emergencies don't wait, and bull markets may not arrive when expected. Now let's talk about what you can buy with $20,000 in 2026. $20,000 may seem like a lot. It is a lot compared to having nothing, but let's do the math. If you lose your job and your monthly expenses are around $4,000, $20,000 will get you about 4 to 5 months. If you experience a serious health issue, the average maximum out of pocket cost for health insurance plans on the market is about $9,450 for one person. A serious health issue could wipe out half of your savings. If your car is totaled, a reliable used car costs between $8,000 and you'll be facing an expense of around $12,000. $20,000 is not a small amount, but it is not enough to weather multiple disasters that strike one after another. And the thing is, life doesn't send disasters one at a time. Let's ask ourselves this question together. So what is the solution? How can you use $20,000 in a way that won't leave you feeling broke? Most advice fails at this point because it is written by people who have never experienced this stage. They tell you to invest everything after covering 3 months' worth of expenses. However, if you work in a volatile industry, you have to look at if you have dependents or live in an expensive area. 3 months is not enough. They tell you to categorize your savings, emergency, short-term, long-term. But they don't tell you how to decide how much to allocate to each category when every category is urgent. Here is what really works, which I learned the hard way. I'll explain these in 3 separate layers, which you can consider as a starting point. The first layer is your untouchable base. This is money you won't invest, spend, or touch unless it is the worst case scenario. For most people, this is 6 months' worth of minimum expenses, not your current lifestyle, your survival budget, the amount you'll need if you lose your job tomorrow and have to cut out all the non-essentials. If your survival budget is $3,000 a month, your foundation is $18,000. If it is $4,000, your foundation is $24,000. Notice anything. If your foundation is $24,000 and you've only saved $20,000, you are not actually in the growth phase yet. You are still laying the foundation. You are building the foundation. That is okay. Most people are, but you need to know what stage you are at. The second layer, which will sustain continuity after this layer, is your opportunity fund. This is the money you can invest on top of your foundation. Also, remember that no investment advice is given on this channel. If you are going to invest, consult a financial expert. Boring, diversified, low-cost index funds that track the market. This is money that can be allowed to fluctuate because you won't need it for at least 5 years. Don't panic if the market drops by 20%, because this isn't your survival money. This is money you are saving for your future. How much money should you put in here? Once your foundation is fully funded, everything extra. If you are saving $500 a month after your foundation is complete, the entire $500 goes into the second layer, because you don't dip into this money when you are facing hardships in life. Compound interest really starts to kick in here. The third tier acts as a buffer for your lifestyle. This is the money that allows you to say yes to things without feeling guilty. Travel, a nicer dinner, things you want but don't need. How much money should you allocate here? Whatever is left after the first and second tiers are funded. For many people in the $20,000 savings range, the third tier is zero. And that is okay. It is temporary. As your foundation solidifies and your opportunity fund grows, the third tier naturally begins to form. However, trying to fund the third tier before the first and second tiers are solid will leave you feeling broke even after saving $20,000. Now let's address a topic no one wants to admit. What if you've already spent the $20,000? What if you reached that amount, felt secure, improved your life, and now you are back down to $12,000 or $15,000 and feel stuck? First, you are not alone. This is the default path for most people. Second, you are not starting over. You are readjusting. The improvements you made aren't necessarily mistakes. Maybe that nicer apartment actually improved your mental health. Maybe the car you rented is reliable and saves you money on repairs. The question isn't whether you should have made the improvements. The question is, can I maintain this lifestyle while also laying new flooring? If the answer is no, you have to give something up, and that is the painful truth. Falling is awful. It feels like failure, moving from a nicer place to a cheaper one. Selling your car and going back to an older one, canceling subscriptions you've gotten used to. It feels like going backwards. But here is the reframing. You are not going backwards. You are choosing substance over appearance. You are choosing the version that can withstand a shock, rather than the version that is only good while it looks good. Let me give you an example of someone who did this right. There is a guy named Sam. Sam saved $25,000 and raised his standard of living. A nicer apartment, a better car, his lifestyle changed. Within a year, his savings dropped to $14,000. Sam had a choice. He could maintain his lifestyle and remain stuck, or move down a class and start over. Sam chose to move down a class. He moved to a smaller place and was paying $400 less per month. He sold the car he had bought on credit and bought a used car for $6,000. He canceled his subscriptions. This saved him $850 a month. Within a year, Sam went from $14,000 to $24,000. 18 months later, he reached $32,000. Sam still drives that used car. It turned out that a reliable, debt-free car is better than a shiny, financed one. Here is the part that bothers people. The reason $20,000 creates a feeling of poverty is that for most people it is poverty. Not in the traditional sense. Your account isn't in the red. You don't have to choose between rent and food, but you are broke because you don't have options yet. You can't say no without risking everything. If this means a temporary pay cut, it is a better opportunity. You can't afford it. You can't handle two emergencies back. Two back without going into debt. Being broke doesn't just mean having no money. Being broke means having no margin. And in 2026, $20,000 won't give you margin in most parts of the country. It will give you a few months without panic. That is valuable, that is progress. But it is not freedom. Freedom begins when your basic needs are met, your investments grow, and your lifestyle is sustainable. For most people, this means not just savings, but a total net worth above $40,000. However, until you realize this, the situation can seem discouraging. If you've reached $20,000, you can reach $40,000. The skills, discipline, focus, and ability to say no that got you to this point work at every level. After the first milestone, it takes longer to see results because you are no longer just saving. You are building something. So, what do you do next? If you've reached $20,000 or are close to it, here is what you need to do. First, calculate your base, your 6-month survival expenses. Be honest. Not your current expenses. Calculate the amount you could live on if you had to. Second, if you haven't reached your base yet, stop investing. Reach your base first. After that, divide your new savings. Allocate 70% to investments and 30% to building your lifestyle buffer. Third, automate everything. Transferring your money as soon as you receive your salary may be a sensible choice. If it hasn't reached your base level yet, transfer it there. If it has, transfer it to your brokerage firm. If you transfer the money manually, you'll find reasons not to do it. Fourth, increasing your income will be very beneficial. Increasing your assets from $20,000 to $50,000 will take years if your income remains the same. Increase your income by $10,000 and keep your lifestyle the same, and you will cut that time in half. Fifth, protect your base. Once the funds are secured, you'll want to touch that money. Don't touch it. The foundation is the money needed to survive, not the money needed for opportunities. That is all I wanted to say. Thank you. If this video showed you something you weren't aware of regarding your own financial situation, hit the subscribe button. I analyze the stages of wealth that no one talks about, the psychological traps that cause people to get stuck, and the strategies that really make a difference. Leave a comment and tell me where you are right now. Are you currently in the secret money stage? Have you passed this stage? Are you still trying to reach this stage? Let's compare notes. See you in the next video.